Hi, class, and welcome to Chapter 4. Chapter 4, we're getting into the fundamental analysis of valuation models. There are certain models that are utilized to evaluate, to find out the value of stock, and we'll get into that in Chapter 4. So on today's agenda for Chapter 4, we'll get into how does the company actually make money. When you're looking for the value of a company, valuation, you want to find out how do they actually make money. Is it a product? Is it services? Actually, what is the actual way? Then you're going to get into are its products or services in demand? Do we need AI? Whoa, yes. Do we need, let's say, the old school, let's say, horse and buggy? No. Valuation. How has the company performed in the past, let's say, decade or so? Maybe even in the last 6 months. That's valuation. You're putting the value on the company you're considering investing in. Are the talented, experienced managers in charge? That's super important. You can think about the Enron situations or the other folks who really did some ugly stuff, and you realize that there is no value in the company anymore because of the fact that the management is so corrupt or so, let's say, disorganized that you don't want to invest in that company. Good example right now is Tesla. If you have Tesla investments, you have to think about the political climate, what he's done, and is the value of that stock still going to be actually something you want to invest in? Is the company positioned for growth and profitability? Are they ready to move into the next millennium? Are they ready to move into, let's say, a next global sector? That's important to think about as well when you're doing the valuation of companies. And how much does the company have? Its asset. Is it a top cap, which means a great deal of assets, or is it middle, or is it low cap? That's when you realize if you want to actually invest in that particular company. But how do we go about looking at valuation? I like to put the E in front of valuation and call it evaluation. We're evaluating the company. Is this the company we really want to put all of our money into? So let's start with defining what valuation is. Valuation of a stock depends on an analysis of the company's expected future performance. What is it going to be doing in the future? This expectation is built in a fundamental of the company's cash flow, which represents the amount of cash coming in and going out of the business. We can look here at some of the matrix, some of the money you can see going in and out for Microsoft. That MSFT is the ticker symbol for Microsoft. Microsoft is huge, but are they going to be huge in the future? Yes, looking at these numbers, you know that they're going to be huge, and they've been consistent over the decades. Microsoft is a company you would definitely want to invest in. So now we get to the moment of thinking, do we want common stock or preferred stock? Well, let's understand what preferred stock valuation is. Preferred shares have the quality of stocks and bonds, which makes makes their valuation a little different than common shares. We know that. The owner of a preferred share are part of owners of the company in proportion to the held stocks, just like common shares. Preferred shares are hybrid securities that combine some of the features of common stock with that of corporate bonds. So some of the takeaways, they are equity securities, but they share many characteristics with debt instruments. Preferred shareholders also have priority over a company's income, meaning they are paid first when they have to pay all the other, let's say, folks they're indebted to. As a result, preferred shares must be valued using techniques such as dividend growth models. So how are we going to be making money if we have preferred shares in stocks? That's a valuation model. Preferred stock valuation models. If preferred stocks have a fixed dividend, then we can calculate the value by discounting each of these payments to the present day. The fixed dividend is not guaranteed in common stock. We know that already. When you have common stock, there's no guarantee because the folks who are paid first are the preferred stock. That gives you a valuation in terms of do you want to do preferred stock or get common stock? If you take these payments and calculate the sum of the present value into perpetuity, you will find the value of the actual stock. So what is common stock valuation? What is their method? Well, a popular method is the matrix of the P/E ratio, which divides the stock price by earning per share. So in other words, you're looking to find out how much you are standing to gain based on the discounted cash flow valuation model. So growth versus value characteristics. So growth stock are higher PE ratios, higher PB ratios, faster earning growth, no or low dividend yields. That is our growth stock we're looking at. Value stock is the low, so just the opposite, lower PE ratio, lower P and B ratio, and slower earnings growth, higher dividend yields. So what is PE ratio? The PE ratio, or price to earnings ratio, is a quick way to see if a stock is undervalued or overvalued. Here's examples of value. So growth stock versus value stock. You can see from this illustration that the growth stock grow at a faster pace compared to the industry and competitors. It is bought at a fair valuation, though at a higher PE valuation, higher growth rate of top and bottom line, and the rest you can read for yourself. But it gives you an idea of the strategies, the characteristics, and some of the dividends that you will see. So growth versus value stock. And again, we're going back to understanding how we are valuating stocks. So understanding a company's fair value. If a stock is currently traded at a low above what the valuation feature calculates as the fair value, we say the stock is overvalued. If a stock is currently trading at a low or below what the valuation feature characteristics as the fair value, we say that the stock is undervalued. Pretty simple. If a stock is currently trading at a low close to what the actual valuation feature calculates as a fair value, we consider the stock is near fair value. So we're pretty close to what we think the stock should be actually valued at. So how do we calculate fair value of common stock? Well, the Peter Lynch model and or theory, fair value calculation assumes that when a stock is fairly valued, the trading P and E ratio of the, I should say trailing, of the stock, which is price versus EPS, will equal its low term EPS growth rate. Fair value equals EPS times EPS growth rate. Not a calculation there. A lot of these calculations can be done through Excel. If you are confused with it, I always suggest people go on to YouTube University, as we call it, and just punch up calculating fair value. And I have a lot of videos that will explain it in more detail. And just as a reminder, this is just a simple overview of what Chapter 4 is going to actually teach you. So I'd like you to continue looking at the rest of Chapter 4, and we will get ready for Chapter 5.